All right, this is a special edition of NewsNation on all kinds of different platforms after our regular television broadcast had wrapped up on NewsNation. Now I'm Connell McShane, along with my buddy Doug Flynn from Flynn Zito Capital Management. Geez, it's been a crazy few. I was going to say few years, few days in the markets and in the economy. So we're going to spend some time here this evening answering people's questions. And we thank some people have already sent in some questions, which we appreciate. And Doug and I do our own podcast, which we put up the other day, where we were getting into a lot of these issues where I feel like now you have time, Doug, right, where we can take a deep breath. The president's paused the tariffs on most countries except for China, and think about, all right, I've been going nuts here watching the market go up and down, but I'm just a regular person, saving and for my retirement, and maybe I'm spending a little too much time on this. What should I be thinking about? And that's how most people, I think, look at this. So, and you're really good at this. This is what you do for a living. So, when people come to you at a time like this, what have you been telling them?
Yeah, you can't let any kind of short-term volatility get you off your game plan. And we talk a lot about separating your money into the time frames for which you need it. So if this is money that you really need tomorrow, then well, you probably shouldn't have had that in the market in the first place. And if you didn't, you wouldn't be concerned about that because you knew you were needing it and you had it out of the market. But if it's your long-term money, it's your 401k money, then these kind of things in terms of volatility are exactly what you're looking for because you're adding. That's what you want. You have an opportunity to add when things are a little lower, with the idea being that 10 or 15 years from now, they'll
so
be
every month,
higher.
if you make a contribution, essentially it's buying now. So you're it's
Yes.
buying into the funds that you've already said that you wanted to buy. So better now when the
Right.
market's been down than when
And
it's at a
don't
high.
make those major shifts during a time of stress. That's
Right.
when people make mistakes. So when things are calm, that's the time to maybe decide, should I be doing something different? But don't do it under duress. That's what often drives you to the wrong decision.
All right. So send your questions in and we'll pass them around. I mean, we have a few here I want to get to, and then we'll kind of start the conversation from there because it's helpful. People ask good questions. I mean, Kenya on YouTube asked our first question, says, do we move to conservative funds or leave my money in a quote unquote aggressive fund? And that's usually what the 401k plan says. I mean, sometimes you don't even see, or you can, but you don't see the details right away. They just say, hey, you want to be aggressive, you want to be conservative. So how do you answer that question?
Right. So if it's in 401k money, and depending on how old you are, maybe you're in a sort of a target date, which is tied to when you're going to be 65. That's usually the target date that they default you into. And so it'll have a lot more stocks when you're younger, and then it'll gradually get more conservative over time. So the idea is you don't have to make that shift. Now,
Right.
if you've chosen the risk version where you've chosen to be aggressive, then it isn't going to automatically move it. So you have to either do that manually, or this is where you get into those considerations of, should I be doing something different? I don't think so if your goal is still decades out. But admittedly, if this money is money that you need more near term, because we don't know what the goal was with this money, then yes, it probably should get more conservative. I don't know that today's the day today to do it, but perhaps at the next all-time high, you put that on your calendar and you say, you know what? I remember how I felt the other day. Let me use that next all-time high to now make that more conservative because I do need that money in the next year or two. That kind of idea to do.
Makes a lot of sense. I mean, I think that's one of the things that, when I've covered financial news for years before coming to NewsNation, and we were so in the moment of the market, and here's what stocks are doing, here's what bonds are doing. And sometimes, and I've told you this before on other platforms, that I don't think it serves the quote unquote normal person very well because they don't want to overthink those things. They ask questions like a user who just asked us on YouTube that gets to time frame and, position in life. User just put it in this question, said, would it be a good idea for someone to pull out now of the market if they want to retire within a few years? And you're probably going to say maybe you wouldn't have, you want to be in the market if you want to retire in a few years, right? So how should people look at it? Is there like like an age scale that you look at, or a position in life scale that you look at in terms of how much you should have in stocks and bonds and all that kind of thing? What advice do you give?
Well, the first thing is, if you're retiring in a couple of years, what that means is it's the first year of your retirement in a couple of years. Ideally, you're going to still be alive for hopefully 20 or 30 more years. So what happens is people think there's like this magic line they cross when they're retired and they need to do things very differently. That isn't the case. If your money's still going to be invested for 30 years, it can remain invested. Now, perhaps, and definitely shouldn't be as aggressive as when you were accumulating when you were 20 and 30, and you need to start shifting it. So I look to these points of doing sort of getting more conservative at a high point, when nobody wants to do it because everything's doing well. But
Yeah.
yes, gradually moving that down. But I wouldn't say get out, because what happens with getting out is you have to make two good decisions. You have to get out right, and then you have to get back in right. That is, even if you call one of them, it's almost impossible to call both of them correctly. So the better thing is have the appropriate portfolio that you can live with for the long term. That's how you win in the investing game.
So when you talk
over the
about
rest of your life.
appropriate, and someone else actually hit on this, I was just looking at our questions that are coming in and use this term, which is, I've heard you say this and others say it, rebalance, as opposed to, all right, I'm going to sell everything in stocks and I'm going to go to cash or all bonds. Well, talk about that a little bit. So
Yeah.
someone just asked that question too. Should I be rebalancing my portfolio? First, explain what that means
Sure.
and when people should be thinking about it.
I love rebalancing. I think it's the single best thing that you can do to pull extra return out of the portfolio over the long haul. It's the
Okay.
cheapest and easiest way to do it. And here's why. So the quick example is, if in 5 years ago, you had a 60% stock and a 40% bond portfolio, oversimplified, but that's a very common portfolio. Had you done nothing, that 60% in stocks would have grown to about 72% stocks today. And then your bonds would have shrunk to about 28% of the total, because the stocks did really well. Now, that's all well and good until the market craters. And then you realize, I didn't just have 60% stocks, I had 72, and I got hurt a lot more on the downside.
Right.
So the concept of rebalancing is, as the stocks are going up, you trim from them and you add to the bonds. And now, had you rebalanced yesterday, even, you might have been taking out of those bonds and buying the stocks, rebalancing the other way. Whatever's up, you're taking from and adding when it's low. And we all know that adage of buy low and sell high, but almost nobody does that. They typically do the opposite. So
Right.
rebalancing keeps you on track with whatever your overall allocation was that you wanted to be, in this case 60-40. And we could talk about whether you should lower that over time, and perhaps you should. But whatever that allocation is, a lot of 401ks, by the way, you can sign up for, and it's free, an automatic quarterly or semi-annually rebalancing. The plan with all the funds you
It does
choose,
it does it for you.
it will do it for you, and that's highly recommended. Now,
And
if you're
60-40 is what a lot of people recommend. 60% stocks, 40% bonds, essentially.
That's right. That's the oversimplified version. There's, within
Right.
stocks, you want to break it down to different types, and bonds, you want to break it down to different types.
Yeah, because to me, like, if you're younger, young people like us, but younger people than us, the stock market never goes down over time. I know it feels painful now, but over the long term,
Right.
it never does. It never has, at least. So if you're,
That's
to
right.
me, it's you be a little more in stocks when you're younger. And then, you get to the 60-40 as you get a little older, and maybe you start going 50-50, or the other
Correct.
way after you pass 50 or 60, something like that. Or
Right. When you start shifting more towards an income need,
yeah,
then you want to start getting below the 50% number. Now, all of this is assuming that you can afford to be that conservative if you saved enough.
sure.
There are some people that weren't able to accumulate all that they needed to, so they have to be a little more aggressive to meet their goals. But assuming you did live below your means, put some money away, and now you can live on it, you can
Right.
afford to be a little more conservative and remove yourself from all the volatility if you have
Oh.
enough, whatever enough is.
Someone just put a question in, which I've been thinking about, because as you know, on TV, when we're doing our show on NewsNation, I've been saying for the last few days that the stock market is not necessarily the biggest story. It's a story, but the larger story for people is probably the economy. And meaning that if companies look at these tariffs, and, the president has the pause in place now, but if he's not able to cut some deals and things go the other way just as quickly as they went up today, all right, companies are going to make decisions, right?
Yes.
And they're going to start cutting back on things, maybe firing workers and that kind of thing. So to me, that's the story that affects most people. But I don't want to minimize the stock market, because my wife was telling me a story the other day about this. It's like, you talk to friends and people have kids coming up on college, juniors and seniors in high school, and they're starting to think about savings and those funds. And someone just asked Diane on YouTube, what about my grandchild's 529? My 529 savings for college. So same advice that you've been giving for 401k plans, because that's a real issue. I see Diane's question.
Oh, right. Yeah. And 529 plans, many of them have similar type of setups like the 401ks, from the standpoint of they have either the year the child is going to go to college planned, or the age of the child as the choice. You can, of course, choose your own funds, but if you choose the age-based version, same concept. When the child is 0 to 3 years old, it's going to be almost entirely stocks. But what it does is it moves it every 3 or so years so that when they're 16 and 17, it's essentially almost entirely out of the market, because the last thing you want when you're 17 is for this to happen and you were 100% stocks and now there's a lot less in the 529. And so what this will allow you to do is be more aggressive when the child has the time and automatically get more conservative. And then when you need it, it's mostly out of the market. So we don't care what happens to the market. The child will take the money out in those years that they're in college, and you don't worry about it.
Are
so
you a
I
big
like
fan
that
of
option a lot.
529s?
What's that?
Are you a big fan of 529s? And in general, I know the only thing I think about sometimes is that it does box you in. I know there are benefits, a lot of them, but it boxes you into using it for education, right? But you like them, generally speaking?
I think if you are the kind of person who wants to save money for your kid's college or grandchild's college, the 529 is one of the best things that you can use, because some states will give you even a state tax break, but whether you get that or not, that's a bonus. The money grows tax-free. There isn't anything else that you can put something in that maybe aggressive in stocks when they're young and move it over and pull that money out 100% tax-free for college. And for the few people that overfund it, because some people are fortunate enough to be able to do that, or their child doesn't need it.
And I do think that's an interesting point that you made about how it's similar to 401k plans in a lot of ways, in that they're treating the child, or they should be, if it's done right, like almost like a retiree. It's, when you're different when you're 4 years old than when you're 16, 17.
And the best part about that, if I can, is that everyone knows when the child's going to go to school. It's not a secret. They're 18 roughly. So we know the date they're going. It's not like, well, I'm retiring here, I'm going to be around for 30 years. No, the child is going to college if they're going to college during these years. So
some exceptions, obviously. I remember when you started at Delphi when you were 12, a lot of people were very surprised by that. That was a big moment. You
graduated early.
Yeah, right. So sometimes you get a genius that goes in early, but it's probably the opposite. They were
doing this a lot longer than people would think.
All right. So that's five. So it's kind of a similar conversation, right? So a couple of other things about 401ks that people are writing in with. One of the questions here, and this goes to the, obviously we're talking on a day when the market shot up, but it's coming off these terrible lows where it was down a lot. And somebody asked an interesting question, was that when you see the market down, should I increase my 401k contribution since stocks are lower? What would you say?
Love it. Yes.
Okay.
But assuming you have money aside for emergencies, and assuming if you have also some other money invested, more liquid, if you have the time frame with the money, because remember, when you put the money in the 401k, you're not touching it until you're at least 60 years old. So assuming you have those other things in place, I wouldn't do that, to not have a cash cushion where if you need tires, you have to go into the 401k. But assuming that you have that covered, yes, anytime you can increase the 401k, it's going to do a number of things, and you're going to be buying at the lower point, perhaps even getting more of a match. Now, maybe you take that off again when things come back up, and then you redirect that. So anytime you're adding in when it's low, think about it. If you could script it, what you want is when you're adding when you're young for it to be really, really low, and when you're older and retired and you have a lot of money, you don't want all that volatility. You want it now when you're adding. So that volatility is your friend. When you're investing for the long haul, you have to kind of shift the mindset. It's not a negative. It's a negative if you need the money tomorrow, but how you avoid that is don't put your money in the market if you need it tomorrow. It's kind of that simple.
No, I think this is really helpful for people to get access. I'm not even joking, to someone like you to do this, because I was joking with Geraldo. Geraldo was on our show earlier, and he says, well, when he heard that Trump was pausing the tariffs, he was having breakfast at the Regency Hotel in Manhattan with his stockbroker. I said, Geraldo, very relatable story. Very relatable story. But many people may not be in that position. So they're like, let's get on the chat and see what Doug Flynn tells me to do with my money. So Scott writes in from Facebook. This is another timing question. Another good question. Scott writes in from Facebook. He says, I'm retiring in 8 years, and I just lost 14% of my retirement savings. And I just moved 40% of my money into money markets. Okay. So he describes his entire position. Should I stay in that position?
Well, what this is saying is that this person was essentially likely 100% stocks with 8 years to go. And then perhaps chose, if he did this yesterday, the worst possible day to do it, to sell out, because now you're in cash and money markets are still paying okay. Long term, they're not going to pay that well as rates eventually do come down. That is a timing decision, and the better way
I
to
can
do
see why people got nervous though in this, in this
can.
market, especially when
And
you
so
get closer to retirement.
and I might argue if you're 8 years away from retirement, I'm going to say you're roughly in your mid 50s. So once again, don't look at your retirement age of 65 or whatever you're going to do in 8 years as this line that once you're on the other side of, you must be 100% safe. No, if you're 55 and you live to 95, this money's going to be invested for you for 40 years. And the reason I know it's going to be invested for that kind of time is
Right.
because all that 401k money that you put away, typically tax deferred. A lot of people have tax deferred. When you retire and you start taking that money out, you got to pay taxes on it. No one is going to take these humongous lump sums out of their 401k and pay all those taxes on it. They're going to take it out monthly over their lifetime. If you're going to take it out monthly over your lifetime for 40 years, we don't really care what happened yesterday. It's more about the 40-year investment time frame. And as we've spoken about a couple of times, over 10-year periods, going back 100 years in the stock market, 98% of the time, the market is positive. There's no 20-year period in the market going back 100 years through the depression, through the wars, that the market has a negative return. So shift your focus on, hey, this is 40-year money. It's not 8-year money. And
Okay.
I would get more conservative at the high point, not the low point. Remember how you felt when it was down and say, okay, I'm going to bottle this. And when it's high and everybody's like, look at what a great time it is.
Yeah.
That's the time to say, I'm going to get more conservative. Do the opposite. And that's how you will really do well. Now, I don't think this is irrecoverable. He didn't sell out entirely. Those mistakes are almost unrecoverable, because if you sell out now, you've missed this tremendous run yesterday, and you have to make better decisions. So
Right.
I might look to say that maybe 60-40 is the right allocation for him. And weird way to get there, but you also ran up really, really well. Look, the market's up 40 to 50% the last 2 years. You lost 15 year to date before today. You're still up 25 in the last 2 years. That's over
Right.
12% a year. You didn't do terribly. We focus in on these like high points on our statement, or when we look online and we think, that's it, I've locked it in. No,
Right.
it's all paper until you actually do something.
No, I know, but but I get why it unnerves people. It unnerved me.
Oh, it
you know,
does.
felt a
It's the
little
short-term volatility. And
relief today. I said, "All right, Trump, thanks for the pause here. Let's all take a pause."
I also
So
think
you-
like this, when clients tell me, hey, this one feels worse. I'll tell you why it feels worse. The most recent one always feels worse.
Of course.
Two reasons. One, you've never had as much money as you do today. So the same percentages
It's true.
are worse because it's a bigger dollar amount, but it
And you're
isn't
closer to
worse.
retirement than you
And
were
you're
then.
older. You've never been
Always.
this old with this
Yeah.
much money.
You don't give a
That's
damn.
why
You're
it feels
25
worse.
years old. You're not even looking at it. Although I got it. My daughter texted me, and and she's 21. The text was, "My stocks." She was really happy. I said, well, it's all of
great.
our stocks.
Yes.
All of our stocks.
And how about today? My stocks.
Yeah, right. Today we're up a couple of thousand points. Nasdaq was up. What's the Nasdaq up? 12%. Come on.
It's
Oh, what a world we
incredible.
live in. So now this other one is another good question about type of retirements. Because sometimes when you leave a job, I know one of my 401ks became an IRA, but someone said, should I prioritize my 401k or IRA, or does it matter, the difference between the two, and when you tell people to use one versus the other, what that kind of thing. What do you say about the types of retirement savings?
Yeah. Well, if you can do it and pay the taxes now out of your paycheck, doing a Roth, no one will ever, down the road, you'll never be mad that you have all that money, no tax ever. Okay. So, but that means you got to pay a little bit more in taxes now to put that. So I love the Roth first, but some people need the tax break. And so they'll want to do a tax deductible contribution. So I'm always a fan of doing as far as you can on the Roth. You're not going to save as much in pure dollars as you would if you did the tax deferred one. But in the end, if you have a bigger taxable number, like people say, I have $1 million IRA. I'm like, tax deferred. I'm like, no, you have a $600,000 IRA because Uncle Sam's taking 40 cents of that. So if you had a $600,000 Roth, that's the same thing as $1 million tax deferred IRA. So
Right.
I would prioritize that first if you can. But whether it's an IRA or a 401k, you've got to take the free money. I say, go to the free money, get a match at your 401k if you have it. go there first and then pause. And then your next decision is, what do I do with my next dollars? Because a 401k, as good as it is, only has a limited universe of options. Typically, you can't buy individual stocks and a lot of other cool investments. So a 401k is great. So take the free money, but the next dollar, decide whether you want to do it in an IRA where you have a lot more investment choices, or within the 401k.
Let me do one more question here. Although I love this format, it's a chance for us to talk and for me to show off the press passes of places I've been that I put behind my office here at NewsNation over the years. No, the last question is this, because we're talking so much about people who are getting ready for retirement and what do they do, but someone who's already retired sent a question in and said, how should I think about my withdrawal rate if I'm already retired? Again, what type of advice?
So you shift to retirement, you're in an income mode. I always think that even, many people know how to accumulate. They know how to take money off their paycheck, put it away. They get 40 years of experience doing that by putting money away. No one really has had any experience on how to withdraw that money. This is the first time they've ever done it, and it's a really important decision. So you do have to think about your withdrawal rate. And so some common rules of thumb you may have heard thrown around is the 4% rule. And where that comes from is you take your whatever money you have, and if you take a 4% withdrawal rate on it, and this is assuming a 60-40 allocation, right, give or take, the idea is that you can withdraw at 4% and give yourself a raise every year with inflation. If it's 3%, whatever it is, you bump it up every year. And that, if you rebalance, should last you the rest of your life. And that's a good target. And now, if that's not enough, because for some people, 4% is not enough, you can go into that's called capital retention, where you're trying to keep that money and maybe pass it down. Some people are like, my kids are going to get other money, or they don't need my money, and I want to spend it down over my lifetime. That's called capital depletion. And you can actually raise the distribution rate, I would argue, to 5 or 6%, again, with that same allocation. And it's a higher withdrawal rate. So your account isn't going to go, it's going to go up a lot. But over time, you'll spend that down. And that typically can get you about a 30-year distribution. And those are oversimplified versions. A financial advisor, a CFP, can actually run a formal plan and give you your specific withdrawal rate based on your risk and what you need is. But general rules of thumb, those are them. But you can certainly hone in on it if you work with an advisor. But those would be the starting points of looking at what I should take. And if you need more than that, now you have to make decisions on, maybe I'm going to run out of money. Maybe I got to sell my house down the road, move in with the kids. I don't know. But those are the kind of decisions that you have to start. Or you have to be more aggressive, which you may not want to do. So those are the inputs to get you the outputs that you need.
Mentioned CFP. Doug is a certified financial planner. He's got a firm that he co-founded out on Long Island in New York. It's called Flynn Zito Capital Management. And he's a regular guest talking about issues like this, but this is a better format for these types of issues because we had more time to answer your questions. Right. He's a regular guest on our show on NewsNation now on television on NewsNation from 3 to 6 p.m. weekdays. Doug's usually on a few times a week, so you can check him out there. And hopefully you're already checking us out there, and we'll see you there tomorrow. But this was a good way. We'll do this again, right, Doug, at some point?
Yeah, whenever you want. It's fun. I love it.
It's more fun to do it on a day when the market was up than the last
for sure.
Anyway, a time to take a deep breath and answer some real questions for real people about your investing. So for Doug Flynn, I'm Connell McShane here on NewsNation. Thanks so much for watching us tonight. And again, we'll see you on TV tomorrow.